Welcome to SF Commercial Property Conversations with Bruce Bean, where Bay Area investments meet expert insights. Get ready to unlock the strategies of commercial real estate success.
So today we've got Eric Berneman with us, and Eric is in the LA area, and he is working with, I must call it the extended family with Golden Bee. I didn't ask you previously, how did the name Golden Bee come around?
I went to Berkeley, as we spoke about earlier, and that's the Golden Bears. And my last name starts with a B. I didn't figure to do a golden bee with the letter B, so I said, okay, let's use the insect, the golden bee. So that's how it came to be. That was it. It was pretty simple.
Oh, wow. Okay, I love it. All right. So give us a little history here of how you went from psychology and environmental science and urban and regional planning into real estate.
It was a family affair, so to speak. I learned the business early on as a young kid, working with my dad and mom in their apartment buildings and going from site to site and going to Home Depot and dealing with maintenance issues and rent collection. And so I learned that early. I always knew it was kind of in my blood and something that I was interested in. That said, went to college, had some other ideas of what I might do and studying other things, and that was fun. As I made my way back to UCLA and studied urban and regional planning, I started to get more in the weeds on real estate and how the economics of it all works and the financial feasibility analyses and so forth. And out of graduate school, went on to work at a consulting firm for about a decade, working with some pretty big developers, Westfield Group, Thomas Properties, a few others, where we were in charge of analyzing, potential sites and how to deal with them and what to build on them, retail market analysis for retail sites and industrial sites and so forth. So learned a lot doing that. And then eventually back in 2011, decided to kind of go out on my own and put together my own investments platform. And the rest is history.
The rest is history. It all came together, and now you're managing about 1,500 units, multifamily.
Correct.
All multifamily, or do you have some other types of property?
No, all multifamily, all based here in Los Angeles, with the exception of a satellite grouping of assets in Las Vegas as well. So we're pretty local. We're a hands-on group. We've got our own vertically integrated management firm and construction company as well. So we really are a high-touch kind of group.
So I'm curious, why Las Vegas?
Yeah, that just sort of happened organically, actually. We started going out there with a friend of ours who started buying single-family homes at the auctions back in the financial crisis. So it was 2009 to 2012. We started going to these auctions and seeing that, you could buy individual single-family homes anywhere from $30,000 to $75,000 each, and replacement costs when we were insuring these was $200,000 to $250,000.
Wow.
And so it kind of became a no-brainer that this was a good investment thesis. And so we started to amass a portfolio of SFRs out there. We got to about 30 homes.
Oh.
And just started to understand the local market, and then eventually sold most of the portfolio in 2019 and transitioned into the multifamily space and have 3 assets there now.
Oh, that's cool.
Yeah.
So, all right. So the family kind of grew. They went to LA. What do you think are you currently in a buying mode? What are you looking at these days?
That's a very good question. It's a tough state of affairs we're in right now. I think the market has kind of been this stalemate where, it's tough to sell things, tough to buy things. That said, I'm beginning to see a little bit of some light at the end of the tunnel here in terms of some of our institutional capital providers and some of our other investors are coming back and saying, hey, we're ready to reinvest. There was kind of a period of, I would say, the last 2 years or so where a lot of folks are kind of pulling back from the commercial real estate space for a variety of reasons, a lot of which we know, and interest rates being higher, cap rates having gone through the roof, expenses and so forth. But I think that we're on the other side of that right now, at least from what I can see. So to answer your question, yes, we are looking at buying some things. We've been looking in Vegas. We've been looking in the Arizona markets and Phoenix and Tucson recently to see if we could expand there. And even here locally in LA, we've been looking in Orange County and other parts of Los Angeles. So we're scouring. It's just a little tough given market conditions, what really is available at a reasonable price point.
Well, and there's a lot of competition out there, right? Everybody's bidding.
Yeah, it's an interesting dynamic. It's like you have the haves and the have-nots. I mean, you've got some assets that, you cannot they can't move at all just given market conditions, especially those that are, here locally in the city of LA, rent controlled environment that's been very hard hit by regulations and so forth over the last couple of years since COVID started. So you have those, and then you have other assets in other locations that, yeah, there are bidding wars. I mean, there's, you're back to the scenario in Vegas. We're seeing this where you've got assets that have, 10 to 15 offers from various institutions that are just trying to deploy capital. I mean, it's kind of interesting. 6 months ago, that was not the case. So obviously, it's changed just in the last 6 months.
Well, I don't think that's interest rate driven. I mean, they've come down a little bit, but I think what people are getting more confident, they now want to buy. There was a lot of dry powder out there, and so they've got it.
Yeah. Yeah, I think it's a sentimental shift. I think, you've got folks on the institutional level who are finally realizing, okay, now's the time to pull the trigger. We're at our low, whatever it might be, or plus or minus, I think that they're finally coming to the conclusion that they've raised all this capital. They have to finally put it to work. So it sort of starts at the top of those institutions. We're starting to see that with some of our other smaller investors and family offices as well that are finally coming back to the table and saying, all right, the stock market is at its, precipice here. It's at its apex, and who knows where that's going to go, given all the things that are happening in the world right now. So, let's go back into the tangible real estate assets that we know, and they're at a low point. So it's a good time to get in.
So I assume that your investors are investing in a single property, or are they investing in the portfolio at large?
So a little bit of both, actually. So we did individual syndications early on in our sequence of syndicating back starting in 2011. It was deal by deal. That transitioned in 2019, where we started to raise more of a pooled fund concept, where we had 7 assets that we threw into a larger pot and then raised a fund for those 7 assets. And so it's been a little bit of both, and pros and cons, I guess, on sort of the methodology. Some folks really like the pooled idea. It gives them some ways to hedge different markets or different locations, different properties. Other folks are, no, I want to know exactly what I'm investing in, the individual asset, and that's it. So, and we've sort of wavered back and forth even as we go forward here, which method we would take. Again, pros and cons to it, but we'll see. We'll see. It kind of really depends on the trajectory and the pipeline that we've got coming. So I think that will probably dictate.
And no intent to go to a REIT, I assume.
No, I don't think we're necessarily at that stage, although that is an option down the line. I think, we had a strategy, for example, that we've been looking at. We've been entitling a 136 unit in South Los Angeles, an affordable housing project for the last couple of years, and we're near the finish line now. And the idea behind that was going to be, this would be the seed into, 5 or 10 other ground up 100 plus unit in LA affordable housing projects. And I still think that would be a great idea. And that would be an appropriate place to then apply a REIT structure to. But I don't know, given today's market dynamics, kind of where the investors really are with this. And we've spoken to, I don't know, about 50 different institutional groups on that sort of project. And it's a little lukewarm, even though the returns look great. And, LA is still has a need for affordable housing. There's just a big anti-LA sentiment that's going on in the institutional level, where they're very concerned about the regulation and what's happened since COVID. And listen, I get it. It's we're dealing with it on our existing assets that are in LA that are really getting hit hard by all these regulatory pressures. So that was an idea that we had, and it still may come to fruition. I think it will depend kind of what next year brings in terms of institutional capital opportunities.
Well, I was fascinated by your LinkedIn post where you increased the value of a property by $7 million by getting a property tax break. So explain that a little bit to us.
Yeah. Yeah. So that was an interesting strategy. That's actually part of our recent fund that I mentioned, where we have 7 assets. We're always trying to find different ways to be nimble and trying to find different ways to add value. And one of the ways, we're pretty well versed in the affordable space. We've got 3 low-income housing tax credit properties that we own and manage. We've always dealt with Section 8 and all the various NGOs over the years, so we know that process very well. So we were approached by a particular group about a year ago about the idea of adding regulatory agreements to existing properties that are currently market rate. In so doing, we would eliminate most, or if not all, of the property taxes at a property. And so we were trying to figure out where to apply it to, and we have these two assets in Long Beach, California that just work pretty well because they are technically market rate, but the rents themselves are effectively at 80% area median income, which means they're kind of already in that band of affordability that would be required by this regulatory agreement. So there really isn't much that we have to do on the ground to change the operations of the building. And so if that's the case, all we're doing is we're applying this regulatory agreement. We're agreeing to bring on this nonprofit partner into the fold, and thereby decreasing our actual operating expenses by nearly $500,000 a year, which equates to almost $7 million in added value. So we just felt like this was a no-brainer and a good way to segue and sequence off of our knowledge base in the affordable world, right? It's not like something we haven't done already. The low-income housing tax credit space has regulatory agreements already in place, and they're more onerous to deal with than this would be. So we're pretty well versed in how to manage it.
So I'm curious, did the nonprofit, did you make it a Section 8 building, or did you take on tax credits? How did that mechanism work?
Neither, actually. So that's the beauty of this agreement, is that basically what needs to happen in order to obtain the welfare exemption, as they call it, or the property tax abatement, is two things.
Is
One,
this from the state, the county, the city?
so there's a nonprofit agency called the California Municipal Finance Agency, and CMFA. That's the group that effectively is associated with the state government that gives us a nominal grant. And I mean, nominal meaning $10,000 for these buildings. They give us a nominal grant, and then simultaneously they add themselves as a nonprofit partner onto the regulatory agreement. And those are the two requirements: is that you need, one, a nonprofit to be a part owner of the building on paper. Again, they don't really have an economic interest. It's just, for
Right.
making sure that you're in compliance with the state rules.
Right.
So they're number one. And number two, there has to be some level of government funding, hence that $10,000 grant. If you check those two boxes, you're now in compliance with receiving the welfare exemption. And so that's how they work it. And they're starting to do this across the state. Not only them, but there are other agencies that are starting to do this more and more. And I think this is going to be the future of a lot of the existing assets that we have in California in particular, trying to ensure that we keep affordability as best we can to that 80% area median income range. And for reference, in LA County, for example, area median income is $100,000 household income. So
Right.
80% of that would be $80,000. So, you're basically saying that we want to make sure that those folks in households that are earning $80,000, or let's say there's two incomes and it's $40,000 income per two people, that they can afford to still live in LA. And so I think this is a great program in general for ensuring, future affordability for years to come. And these are regulatory agreements that are going to be in place for 30 years. So it allows folks to, to stay in a place like LA, which is so difficult given where rents are.
Yeah, that was my next question. How long is this regulatory agreement?
Yeah.
Yeah. So
Yeah, exactly.
30 years, you can bail out. What happens at the end of the regulatory agreement?
So interestingly, we're dealing with that on another asset, which is a low-income housing tax credit property that we currently own in the San Fernando Valley. So that one is on the other end of the 30-year cycle. So its 30 years is going to come up in 2029. And you're absolutely right. There are some interesting things that are going to potentially happen. I mean, option one for us as owner, it's a 200-unit apartment. We're adding 17 ADUs to it as we speak. So it'll be 217 units in 2029. There are a couple options. One, it just goes to market rate. At that point, it's a standard market rate deal. It's still rent controlled because it was originally built in the 60s, but it's a standard market rate deal. So that's option one. Option two would be to bring on a group like this and create a new regulatory agreement to ensure that the affordability is at least staying at 80% AMI. A third option would be to re-syndicate it again with another tax credit and start all over again. So there are a couple different options of what to do with upon termination.
And you've got, 4 years or whatever to try and figure out that equation. So
Yeah, we've got some time on that one. We probably won't own the asset that we're starting on now, so I can't say what will happen 30 years from now on that one. But yeah, it's an interesting dynamic what's happening because there's a lot of assets that were put into some form of regulation in the 90s, and now we're seeing that 30-year time frame come to fruition here, and so it'll be interesting to see what's happening. I know at the state level they are concerned about a lot of these buildings that are going to turn to market and what's going to really happen. So we'll see.
yeah, no, I mean, I work with the Rotary Club of San Mateo, and we have 132 units of tax credit. And anyway, they've both gone back after 15 years. It's a very interesting dynamic, but
Yeah,
the exit process was not easy. So, at any rate, I don't
yeah,
envy your situation there. That can be a lot of legal work to try and make it all go together.
yeah,
Anyway,
yeah. It'll be fun.
that's yeah, that's future or whatever. That'll happen soon enough.
Right.
Okay, so given all that, you've never decided to go into a different asset class. It doesn't sound like.
No, we have toyed with a little bit of self storage and that's smaller industrial spaces. We've looked at it here and there, analyzed a few deals, but we never really made our foray into it. Not for lack of trying. We have tried a little bit here and there, but it's just we don't have the expertise in that space. So part of me, for example, on the self storage side, was thinking of bringing on a partner and co-GPing in some fashion. But then I go back to, okay, well, if we go to our investors and we say, hey, we're trying this new idea, yeah, some might go along for the ride, but I think a lot of those other investors would say, well, stick to what you know. So I don't know. That's at least my sense of it.
Yeah, stick to your knitting. Don't.
Yeah,
Well, I assume since you're managing in-house, what are you using? Yardi, what do you use for software?
we use Appfolio.
Appfolio. Yeah,
Yeah.
okay. So then that's working out just fine.
Yeah. Yeah, no, it's we've been a client of Appfolio since 2013, so we've been through a lot of different iterations. We use their investment management platform as well, which is great. So it's all synced up, and yeah, it works very well. I mean, I know some other folks speak highly of Yardi as well. We've played with that from time to time, especially as we purchase assets. We see some of their data, but we've never really had a reason to move on from Appfolio. It works well.
Yeah. No, I can understand completely. So it sounds like based on what you've said so far, that you're kind of in a yes, we want to buy right now, but it's difficult, and you're probably going to still stay in the LA market. I did not realize LA was a rent control city. How severe is the rent control?
Yeah, it's pretty extensive. I mean, it's probably next to San Francisco and Berkeley, next on the list in terms of its level of sort of onerousness. It's just I think that in the last 5 years since COVID hit, it really has just propelled into something as a much bigger phenomenon than it originally was. I mean, I think the original concepts, when we were first buying in 2011, 12, 13, those assets, it was fine. We knew what we were getting into. We understood the market and we were able to meander the path through the rent control rules. But the rent control rules have changed so dramatically and they're still evolving. They're talking right now at the county level of doing another eviction moratorium because of the ICE raids. And although I feel for all those folks that have been impacted by that, this is yet again all over where we had the eviction moratorium during COVID for 4 years. And here we are again with another excuse to do one. And it's like, well, look, government, local government, if you're concerned with that, by all means, please help these people out. But why is the onus on us as landlords and owners and operators of assets to foot the bill? And that's what ends up happening with all of these. And, I go back to the time when we were deep in COVID and, I mean, we're still out almost $2 million in income, for that period of time where we didn't have rental income coming in, even though there were all these subsidies and helping hands and whatnot. It's still we ended up eating quite a bit of cash flow that never came. So it's highly impactful, and I think that those regulations really have a meaningful effect on our ability to continue to invest locally here in LA. I mean, it's very difficult. So we'll see.
Yeah, I just interviewed John Protopapas. I don't know if you know that name from the Berkeley world. Any rate, he has a lawsuit stemming from the pandemic basically saying that the the state and the feds were having a taking, basically the
Yeah.
situation you're talking about. And he expects this to go to the Supreme Court, maybe another, who knows, 2 or 3 or 4 years before it gets there. But it'll be interesting to see how that all pans out. It did go through the California Supreme Court,
Yeah.
and they ruled it down, and he expects that now to bounce up to the Supreme Court. So
Yeah, I did hear about that case, although I didn't know who was behind it. But yeah, listen, I'm hopeful that turns into something. I mean, it's again, COVID, all these various emergency situations that we've dealt with over the last 5 years. Understandable. They're totally understandable, and they deserve emergency status. However, who is the bearer of that emergency cost? And
right.
it should be the government. It shouldn't be the private landlords. And that's what's unfortunately been happening, especially here in LA. And that's
Wow.
the tough part. So, but we'll get through. We always do.
All right. Well, I want to reconvene in 6 months and just kind
Yeah,
of see how we're doing. This is
that'd be
very
great.
educational, very interesting, and I think the market is in a very dynamic mode right now. So it'll be interesting to see what pans out in the next 6 months. So let's reconvene and go from there, and we'll talk soon, maybe.
Sounds good, Bruce. Appreciate the time.
So where can people get a hold of you?
You can, by all means, go to our website, goldenbeeproperties.com, or you can feel free to email me at david@goldenbeeproperties.com.
Well, David, this was very interesting, and I'm looking forward to reconvening in the near future.
Sounds good, Bruce. Thanks so much. Have a good night.
Talk to you soon.
That's a wrap on today's journey through the SF commercial real estate scene. Ready to share your story? Visit sfcommercialconversations.com/guest. Your insights could lead the next conversation.